In 1929, Joseph Kennedy made three specific trades. 6 months before the crash, he converted to cash. He bought gold. He positioned for volatility. When the market fell 89%, Kennedy made $50 million, while everyone else lost everything. In 1987, Tudor Jones made the same three trades. On October 19, when the market fell 22.6% in a single day, Jones made $100 million in that one day alone. In 2008, Michael Burry, John Paulson, and others made the same three trades: cash, gold, volatility. They made billions while the financial system collapsed. And right now, in 2025, Warren Buffett, Ray Dalio, and Bill Ackman are making the exact same three trades, not two trades, not five trades, three. These aren't random strategies. This is a mechanical pattern that repeats because crashes follow the same sequence: extreme valuations, excessive leverage, a triggering event, forced liquidation, panic. Let me show you exactly what these three trades are, how they played out in history, and why they are happening right now. Trade number one is the cash conversion. This happens 12 to 18 months before the crash. It is the earliest signal. Let's look at 1929. The market was euphoric. Stocks had tripled in 5 years. Margin debt was at record levels. But Joseph Kennedy recognized the danger. He understood that when everyone is leveraged, there is nobody left to buy. So, in the summer of 1929, Kennedy began systematically converting his stock positions to cash. Not all at once, but steadily. By September, Kennedy was substantially in cash. The crash began 7 weeks later. Kennedy sat in cash, protected. Fast forward to 1987. Tudor Jones. By mid-1987, he saw valuations were unsustainable. The Dow had risen 140% in 5 years. Jones did the math. He concluded a crash was inevitable. In September 1987, he systematically reduced his long positions. He converted to cash. When the crash came on October 19th, Jones was already out. Then came 2008. Michael Burry started converting to a defensive position in 2005. John Paulson did the same in 2006. Warren Buffett raised his cash position from $40 billion to over $60 billion by 2007. They were all substantially in cash before the collapse accelerated. Now, look at 2025. Warren Buffett is currently sitting on $325 billion in cash. Let me repeat that. $325 billion. That is the largest cash position in corporate history. Buffett has been systematically selling stocks, reducing Apple by 50%, selling Bank of America. In his shareholder letter, he said explicitly that he cannot find anything attractively priced. That is code for everything is overvalued. Get out. But it's not just Buffett. Jeff Bezos sold over $13 billion in stock. Mark Zuckerberg sold billions. Jamie Dimon, CEO of JPMorgan Chase, sold stock for the first time ever in his tenure. Insider selling across corporate America is at levels not seen since 2007. These are the people running the companies. They see the real data, and they are converting to cash. Trade one is happening right now. The smart money is out. Trade number two is gold accumulation. While you are sitting in cash, you are exposed to inflation and currency devaluation. Gold is the 5,000-year solution. In 1929, Bernard Baruch didn't just convert to cash, he converted to physical gold. He understood that the crash would eventually lead to currency manipulation. When Roosevelt devalued the dollar in 1934, gold was revalued from $20 to $35 per ounce. Anyone holding gold saw a 69% gain in dollar terms, virtually overnight. In the 2008 crisis, gold surged. As banks failed and the Fed started printing money, gold went from $600 in 2007 to over $1,900 by 2011. Investors who held gold tripled their money, while stocks went nowhere. This brings us to 2025. Trade 2 is becoming critical. Central banks globally are buying gold at record rates. In 2022, 2023, and 2024, they purchased over 3,000 tons of gold. This is the highest three-year total since 1950. China is buying, Russia is buying, India, Turkey, Singapore. They are diversifying away from the dollar. They see what the smart money sees: unsustainable U.S. debt and inevitable currency devaluation. Ray Dalio holds 5 to 10% of his portfolio in gold. Gold is trading at record highs because the smart money is executing trade 2. Right now, trade number 3 is the volatility bet. This is the profit trade. Trade 1 protects you. Trade 2 preserves you. Trade 3 makes you rich. This happens 6 to 12 months before the crash. It requires instruments that pay off massively when markets collapse. In 1929, it was shorting stocks. Kennedy made roughly $50 million from short positions. In 1987, Paul Tudor Jones bought put options. On Black Monday, when the Dow fell 22%, his options exploded in value. He made $100 million in a single day. In 2008, it was credit default swaps. This is the big short. Michael Burry and John Paulson bought insurance on mortgage bonds. When the housing market collapsed, those swaps paid out billions. John Paulson personally made $4 billion. And now, Trade 3 in 2025. The instruments today are credit default swaps on commercial mortgage-backed securities, put options, and VIX calls. The cost to insure against defaults in commercial mortgages has increased 300 to 500% since 2021. Why? Because sophisticated investors believe commercial real estate is on the brink of collapse. Office buildings are 40 to 50% vacant. Mortgages are maturing at high rates. Defaults are inevitable. Large institutions are buying put options expiring in late 2025 and 2026. The put-call ratio is elevated. Bill Ackman has signaled he is considering hedges similar to his 2020 trade, where he turned $27 million into $2.6 billion in weeks. The volatility bets are being placed. Why do these 3 trades work every single time? Because every major crash follows the same mechanical sequence. Stage 1, the bubble. Asset prices disconnect from reality. 2025 stocks are valued at nearly twice GDP. Stage 2, euphoria. Everyone believes this time is different. AI will save us. The Fed will save us. Stage 3, maximum leverage. Margin debt is near record highs. Stage 4, the trigger. It could be a bank failure, a geopolitical shock, or a tech collapse. It doesn't matter what starts it. Stage 5, forced liquidation. This is the death spiral. Prices fall. Margin calls trigger, forced selling. Prices fall further. Stage 6, panic. Liquidity disappears. The VIX spikes to 60 or 70. This pattern is undeniable. If you execute the three trades, you unlock the implicit fourth trade, buying at the bottom. When the crash comes, likely late 2025 or 2026, and panic is at its maximum, unemployment is high, news is apocalyptic, that is when you deploy. You use the cash you preserved. You use the purchasing power of your gold. You use the massive profits from your volatility bets. You buy quality assets at fire sale prices. This is how Kennedy, Baruch, and Buffett built generational wealth. The three trades have been made. The pattern is repeating. The only question remaining is, will you be positioned when the clock strikes 12?